Welcome back, everyone. We're now going to move to our second part of this session 2, which is on financial inclusion in the CET region. As I mentioned before the break, we're joined by two regional experts who will be giving a presentation on this. We are joined by Goraz Sibe, Director at the Insurance Supervisory Agency for Slovenia, and Klime Popusky, Professor and former President of the Insurance Supervision Agency and University of St. Clement Ohridsky. Apologies for my mispronunciation, but Goraz, Klime, the floor is yours.
Thank you so much. Okay, so we continue today with the training, and first of all, I would like to thank the organizers for inviting us to the inclusive insurance training for insurance supervisor in the CET region. Of course, it is our great honor to be here together with Professor Klime Popusky, and we have been working together on numerous projects together, and we'll try to give our best from our side to present you an overview of financial inclusion in the CET region, which is also based on the most current studies of the market and data that we gather through the surveys that were conducted in the CET region. So we are very pleased that we got a lot of responses, which is of extreme importance for us. So this is how we can present the analysis also in the meetings like this. I will just give a couple of introductory words about the microinsurance, and then we will be presenting also the surveys. It is clear that since the 90s, the microinsurance movement has demonstrated the benefits of insurance for low-income people, as well as exploring new. And microinsurance models match their premiums and benefits to the needs of these groups. And today, inclusive insurance expands this market and product development work to all those who have not been served by traditional insurance, including the lower middle class, and they should also retain a particular emphasis on vulnerable and low-income populations. We can basically define inclusive insurance as access to and use of appropriate and affordable insurance products for the unserved and underserved population, with a particular emphasis on vulnerable and low-income populations. And whatever the language or specific target, it is quite obvious that both traditional and new insurers are breaking open new markets through new business models on one side, the different technologies, product design, and also partnership. And all this is made possible by enabling regulatory environments. If we can move on to the next slide.
This one?
Nope, this next one. We are still on the first page.
Okay. You mean this one?
No, we are still on the first page, unless somebody else can see differently.
No, we're still on the first page. Klime, let me try and help you actually. I can move the slides.
Okay, that would be great. Okay.
Perfect.
This is the agenda for today, and we decided with Klime that we share the topics. I will firstly present the CET region, key regulatory and supervisory topics in the region, and the insurance market landscape. And this will be followed by presentation from Klime, and he will cover the topics such as insurance protection gap, and which is very important potential for inclusive insurance market development, and the focal point will be also on the current state of inclusive insurance, and we will present the survey of the survey results of the recent study we have made together, also with Access to Insurance Initiative. And last but not least, we will look in the future about the future perspectives. Moving on the next slide. Here is just this map that represents the CEET region, which basically consists of 31 countries. And of course, they represent a different level of economic development. Based on the World Bank income classification from 2020, 20% of the CEET region countries are classified as lower middle income economies. 40% of the CEET region countries are classified as upper middle income economies and 40% as high income economies. The population within the region amounts to 506 million, which consists of almost 6.5% of the world's population, which is basically even bigger than European Union altogether. And in the world terms, we are now 7.8 billion in 2020. So it is a very important and big region. Since the 1990s, the countries of the CEET region, they have largely transitioned to market economies with democratic form of government, and now participate in global markets for goods and services. While also many of these countries have experienced significant economic growth, including a growing financial services sector, they constitute and still continue to face a large insurance protection gap. CEET insurance markets face an uphill battle in providing personal insurance coverage to a population that has long been entitled to social welfare payments from either their governments and is largely unfamiliar with insurance products. And this, of course, provoke quite of a problem for this region. I will just spend a couple of words about the role of the regional coordinator, which I am for currently for a 2-year mandate. And it is like a focal point for all the regional matters within the CEET region. And I consider this region extremely challenging. It consists of many countries with different development of insurance market, insurance penetration, and insurance density, which consequently mean that sometimes it is hard to balance the needs and all the priorities of particular countries when you consider the region as a whole. To cut it short, our region is very diverse, and insurance markets and supervision diverge also substantially. Therefore, I would like to emphasize that I believe that we can all benefit from the cooperation between the CEET region members, including especially with knowledge and experience transfer. If we can move to another slide, please. I will just briefly explain some of the regional activities that that were done during the period of during the period of 2 years. We have come up with numerous online trainings, virtual seminars, and we conducted survey among the members to get relevant data on specific regional matters. We had a regional seminar. It is an online course on insurance supervision and risk management for insurance supervisors from the CEET region, where risk-based supervision and improvement of risk assessment techniques and solvency to implementation was presented. And it was the aim to go more in-depth topics exposed by CEET supervisory authorities. And we had quite a good participation of more than 40 participants from 13 different CET countries, which is pretty much same as today. Furthermore, we also presented Financial Stability Institute tool webinar for the EAS CET region, and the aim was to get the CET region familiarized with the learning opportunities offered by FSI tool. So it is a very good tool, and I encourage you to use it. We are also one of the organizers of Inclusive Insurance in the CET region conference, Challenges and Opportunities, which will be held on the 1st and the 2nd September. Together with Munich Re Foundation and Access to Insurance Initiative and Microinsurance Network. So you're very welcome to also apply for this conference. That is why I also put the link where the registration is already open for those who are interested in this. Furthermore, we conducted several surveys. One of those will be presented as well today. Especially the survey and the distribution channels within the CET region, where the aim of the survey was to get a better understanding and insight into the regional insurance distribution requirements and expectations in order to shape the strategy for regional coordinations for the future. Then, furthermore, we also had another survey, which was initially titled "Do Households Borrowing Constraint Affect the Insurance Profitability?" And we provided a thorough empirical investigation of determinants of the life insurance performance, taking on board evidence, especially from the Southern Eastern Europe. Last but not least, the survey on the inclusive insurance regulatory landscape in the CET region. We conducted together with I2AI, with also strong support from Klime. And this we will hear later on today, where Klime will present also some of the results. One of the main topics also that IAS also identified as important is, I believe, also climate change. As far as I understand, you will also be covering these issues today. And another one, very important topic, is also not just for the EU members, but also for those who have groups based in the US. This is, of course, the Solvency II review. During the Slovenian presidency that just started a couple of days ago, I will be leading also the dossier that will start the negotiations for the Solvency II review. And together with my colleagues, we have been working quite hard to get all different perspectives. And I think it will be also in a position later on to present to the region for those who are interested and affected by the Solvency II review and explanation and insight on this topic. Some other topics that are also very interesting are conduct of business supervision, recovery solution, and of course what we are lately all we are all very much hearing the topics such as the digitalization, fintech, and insurtech. If you can move to the next slide, please. I will just shortly present you with a survey that was conducted by our Insurance Supervision Agency. That was back in 2019, but I believe the results haven't changed much in the meantime. This was the CET region survey of the supervisory landscape. We started with this survey just to get a general overview of the region, and we got some very interesting results. Even more because since 2/3 of the IAS members of the CET region responded to the survey, and the respondents are also well distributed within the CET region, the results should be viewed as broadly illustrative of the region, and are still very much relevant today. In the first part of the survey, we were interested about the authorities and working environment, and we found out that almost half of the authorities that responded are independent supervisory authorities, whereas 47% of those are part of the central bank. So it is evenly distributed between the two. Only one authority within the region is part of the ministry. Of course, each type of authority has its advantages and disadvantages. So it is sometimes difficult to determine which type is the best. So we don't give the final judgment on that. But on the other hand, this information can help us understand what kind of assistance and technical support the authorities also receive. The authority powers in most cases refer to both supervisory and regulatory competencies. And this is a positive signal that implementation of IAS standards and guidance is to a large extent in the hands of supervisors themselves. There is no authority that would have only regulatory power. We have also find out that in 89% of cases, authorities have the power to investigate the policyholder complaints and order the correction of deficiencies. Some authorities have also explained that they, as an authority, cannot solve complaints, but the number and nature of complaints are investigated and taken into account when analyzing these supervised entities and conducting on-site examinations. Also, a large part of authorities supervise the insurance sales channels, while others stated that they can supervise all insurance brokers and not insurance agents. Also, also, if you can say that in 79% of cases, authorities have also a desire and the need regarding building supervisory capacities, and authorities also specified which of the topics are of the most importance to them. They were able to choose between multiple responses, and this will be seen on the slide. So if you can just move on. If we can move the slide to another one. Pascal. Can we move the slide?
Is the slide not moved over?
Sorry?
Are we on slide 7? Where is that?
Yes,
yeah.
If you just move the slide.
Okay.
Another one, take next one.
I only see slide 5 right now.
I see.
We should be on slide 9.
Yes, we are. These building supervisory capacity topics. Okay, now I can see that I can move also the slide, so it's okay. Am I moving now the slides, or you are, Pascal? Because it's a little bit confusing right now.
I'm still moving them.
On which slide? Can you tell me the?
We're now we're now on slide 9.
How is it?
Supervisory capacity.
Building supervision. That's the correct one, exactly. Here. I would just like to mention that important challenge that I can also see as a regional coordinator, that the whole region has very different needs regarding insurance supervision than the rest of Europe. And for this reason, I think that a more regional approach to market is needed. This means that in particular, we should take into account not only dominant views and directions of certain countries, but also the thinking and evaluations of other countries. And both Europe and CEET region bring together countries that are very different, from different economic development, different market sizes. And this means that challenges of different countries are also different. Countries with a small insurance market do not benefit from, for example, an advanced IT solutions for processing data, as they reviewed all data manually. And here are some of the topics that are of the great importance. As we can see, Solvency II implementation is leading, and then it is followed by life insurance, cross-border supervision, group supervision, climate change risk, and of course, agricultural insurance, which is also part of inclusive insurance. If you can move to the next slide. Here we can see some of the responses where the members of the CEET region highlighted topics where they will need some further support, and this is obvious latest IFRS developments and countering fraud in insurance, anti-money laundering, combating the finance of terrorism, microinsurance, very important, insurtech, IDD, big data analysis, and at the end, the regulation of IT technologies that are used in claims handling. If we can move to another slide, I think that I'm not seeing the same slides as you do, but right now I'm on building supervisory capacity. This is how we do it. Are you on the same slide?
No, we are on slide insurance landscape for CET region. Can you?
I only see slide 9 myself.
We are on the slide in building supervisory capacity, right? This is the slide I see.
Yes.
Slide number 9.
Yes, that's correct. But no,
okay.
I'm actually moving it more along. So I'm not really sure why it's not moving on my side.
Okay, I will just tell you the number of the slide. This will be the most easiest way to proceed. So we are now on the slide number 9, which is about building supervisory capacity, how we can do that. It is obvious with continuous educations, with the different trainings and seminars as we have it right now. And it is very important that the region also exchange best practices, examples, and this is the way how they can create a stable insurance market and promote financial stability. And they should be, of course, also in close interaction with also other insurance supervisors. And supervisory convergence, this is also one of the main goals of EIOPA, so to speak, and this is also the way to go forward. And now, finally, we are coming to the second part of presentation, which is insurance market landscape in the CEET region. This is now slide 11, which is this is early studies of the insurance markets in the CEET region, indicate that they're mostly and monopolistic, uncompetitive, and relatively young market. The privatization of the insurance sector, liberalization, the regulation of financial services, and harmonizations with the insurance core principles prescribed by the AS were significant pathways for successful reform of the insurance industry. The majority of the CEET countries have indicated to join the EU. All are also in the accession process, which means that their domestic jurisdictions must transpose the EU insurance directives. Of course, also there are some favorable economic developments in improving the living conditions. There is more and more risk and insurance awareness, and what is important, the entrance of foreign-owned insurance companies. They are those driving factors for the insurance market developments. It is, of course, on the other hand, also extremely important to establish independent, effective, and efficient insurance supervisory authorities that can be equipped with sufficient resources on one side, also trained professionals, and many times actuaries are quite in need in some of the countries. The main characteristic of this very divergent region is the significant cross-country differences and in insurance developments. It is the region that is very heterogeneous in many aspects, be it from political, economic, finance, and insurance. And the markets, they differ significantly regarding the size, concentration, and level of maturity. And these indicators are to be used to assess this market the characteristics in terms of gross written premium volume or insurance penetration. This is the premium in percentage in GDP, and insurance density, which is in premiums per capita. So here in this graph, you can see that it is divided into three groups for EU member countries, Western Balkan countries, and Eastern European countries. If we can just, now we are on the slide 12. On the slide 12, we can see how we can illustrate the CEET insurance landscape, the size of the insurance markets. They are measured by gross written premium volume, which is linked to the indicators such as insurance density, insurance penetration. We can see on this graph the market size. It is indicated by different bubbles. We can see Russia, Turkey, Poland, and Czech Republic are by far the biggest markets. Insurance markets in Central Europe are already much more developed than the insurance market in Eastern Europe, whereas the insurance markets of Southeastern Europe are somewhere just in the middle. Slovenia is showing significantly higher insurance market indicators than the other countries in this geographical segment. And we are finally moving to the last slide of my presentation, slide number 13, which is, we can see on this slide that the CEET insurance industry is, of course, increasingly dominated by the non-life sector, specifically the motor segment. In portfolio terms, the motor insurance lines, MTPL, had the strongest contribution, and they can provide up to 1/3 of the total premiums volume. The MTPL class contributed by itself with almost 22%. On the other hand, which can also be a bit of concern, is life insurance, which plays a less significant role and suffers from a general lack of awareness. So again, it is important to have the educational event to promote also this segment. And this is where I will stop my presentation, and I will hand it over to Klime, who has also some very interesting topics to share with you today. So, Klime, back to you.
Okay.
Thank you.
Thank you, Gorest. Thanks a lot. Pascal, so we'll continue from your side to change the slides. It's
Sure.
okay? Okay.
Yeah, no.
So, thank you. Okay, also it's my great pleasure to participate in this training, and I'm particularly happy to share with you the first ever inclusive survey that was conducted for the CET region. But before come to the survey results, I would like to address some important questions, some important dimensions of the insurance business, which is related with potential for inclusive insurance. So I will start my presentation by addressing one of the most important concern, that is insurance protection gap. Next slide. So insurance protection gap we describe as the difference between the total losses and insured losses. Protection gap is also very valid for the CET region. Protection gaps differ widely in terms of size, nature, and dynamics, depending on the line of business and the general maturity of the insurance market. Historically, uninsured natural disaster losses were the root of the protection gap discussions. The Swiss Re Institute from Swiss Re Reinsurance Company estimates that the combined global protection gap was a record on 1.38 trillion US dollar in 2020 in terms of premium. These protection gaps come from natural catastrophic mortality and healthcare risk, and it's double comparing to the level of 2002. Only 1% of the natural disaster losses in developing countries was only insured. This compares to the coverage of 30% in developed country. Next slide. There is a huge difference between the various country income groups. The catastrophe risk coverage level is 35% in advanced economies versus 6% in emerging economies, but they are far more pronounced in, of course, in emerging economies. Emerging economies or developing countries are the most vulnerable to climate change. More than 60% of the global gap originates from developing countries. The biggest gap in US dollar terms is in the health insurance, with in total 747 billion US dollar, which is higher comparing to 231 billion US dollar for natural catastrophe. But according to the Swiss Re Insurance Resilience Indices, natural catastrophic risk has the lowest level of coverage in percentage terms, which is 24% globally. Closing the protection gap may be like scaling a mountain for insurance and governments. The barriers to progress in emerging and developing countries include a lack of understanding how private-public risk management cooperation can improve resilience, as well as the political challenges of financing risk transfer solutions triggered by methods other than actual losses. There was a general mentality among public bodies to effectively self-insure disasters and think and seek funding after an event, and that while the industry has had a few success in trying to change this, it is still early days, and that the generate notation that we pay for it once it happens prevails. Next slide. The CET region risk landscape is very diverse. The region is largely exposed to the following main natural disasters: earthquake, floods, windstorm, drought, to a lesser extent to landslide, hail, winter storm, and wildfires. Our vulnerability to natural disaster risks depends on exposure, preparedness, and the ability to absorb losses. The World Risk Index, developed by the United Nations University Institute for Environment and Human Security, show the risk of disaster in consequence of extreme natural events for the CET region. It is calculated on a country-by-country basis through the multiplication of exposure and vulnerability. Exposure covers threats due to earthquakes, cyclones, floods, droughts, and sea level rise. Vulnerability is comprised of three components which are weighted equally in the calculation, and those are susceptibility, coping, and adaptation. The risk range is from 0.09 to 36.45. According to the risk, countries with very high risk exposures are Albania, Montenegro, Romania. In the second group of countries with middle level of exposures are Macedonia, Bosnia and Herzegovina, Hungary, Serbia, Turkey, and etc. So you can see that the CET region is very high exposed to the natural catastrophic risks. Next slide. Now, the question is why individuals and businesses buy less insurance than is economically beneficial. The reasons for insurance protection gaps lie with both demand and supply side factors affecting the demand for an provision of insurance services. In addition, they vary for various stages on economic development. On the demand side, affordability remains a relevant obstacle primarily in developing and emerging insurance markets. Numerous empirical studies suggest that a lack of awareness as a result of poor financial literacy or general education plays an important role in explaining underinsurance even in countries with higher levels of per capita income. Product appeal and service quality are of great importance, and they include the ease of buying insurance cover and the rising customer expectation in the wake of digitalization. Policyholder trust in the context of insurance protection gaps is particularly relevant for developing and emerging markets, which are frequently characterized by relatively weak legal and regulatory systems for enforcing payment of valid claims. Culture and social factors can also help to understand insurance protection gaps, ranging from differences in risk aversion to factors attributed to religion, as shown by various empirical analyses focused on low-income countries. Behavioral biases are of more general relevance. More recently, behavioral factors have emerged as explanations for demand anomalies in insurance. One example is loss aversions. Individuals being more sensitive to small losses than large gains. In insurance, the premium is a certain and near-term expense, whereas the claim benefit is uncertain and distant and is therefore perceived as a potential loss. However, insurance protection gaps do not only reflect the demand side issues. Equally important are insurance market imperfections that hold back insurance supply. Transitional costs are one of the most prominent examples. In non-life insurance, for example, about 30% of each dollar premium are generally absorbed by distribution and general administrative expenses. Even though it reflects its complexity, this fact affects the economic appeal of insurance, especially in low-income countries. In addition, imperfect and asymmetric information is a long-standing feature of today's insurance market. It can explain insurance protection gaps as it is said to lead to adverse selection, poor risk being more likely to purchase cover. Furthermore, institutional parameters such as the legal and regulatory environment are major determinants of insurance supply. In many developing and emerging markets, the legal environment, for example, proper contract law, is still weak and rules are frequently not enforceable. In addition to an effective legal framework, a sound regulatory framework is required to enable a stable insurance market and protect policyholders. Last but not least, certain risks do not meet the most fundamental criteria of insurability and are considered uninsurable from a commercial viability point of view. Next. So, what could be the possible solution in order to tackle with the challenges of protection gaps? Any comprehensive and promising approach to narrowing insurance protection gaps require a multi-stakeholder effort. The collaboration of private sector insurers and local governments is of particular importance. The optimal configuration of this multi-stakeholder mix depends on the maturity of insurance market and specific nature of protection gaps. In developing countries, the trend is one of low risk transfer and management capabilities in combination with massive protection gaps. In this case, governments may need to play a strong enabling and guiding role, albeit against the backdrop of limited fiscal capacity. In general, governments can help improve the availability of retail and wholesale insurance by introduction of compulsory schemes which create sufficiently large risk communities and risk pools. In addition, many public sector entities are increasingly utilizing new forms of sovereign risk transfer in order to relieve their balance sheets, especially from natural disaster losses. As a complement to improving risk transfer, protection gaps also need to be addressed through the prevention and reduction of losses. Government-sponsored building codes, for example, have proved essential for establishing and enforcing risk reduction measures. Digital and mobile technologies can go a long way in addressing protection gaps by simultaneously promoting affordability, awareness, and product appeal. Technology also facilitates the product innovation that is generally needed to expand risk pools and might ultimately even help to expand the limits of insurability. And of course, inclusive insurance and promotion of microinsurance can provide a great benefit against the protection gap. Microinsurance provides, as you know, low-income, vulnerable householders with affordable insurance products. Due to the low premiums, key microinsurance features such as product design, distribution channel, and claim settlement process differ significantly from traditional insurance. Microinsurance generally offers small amounts of coverage and premiums per person. Distribution frequently relies on existing networks, sometimes bundling insurance with other products. Claims handling expenses are minimized by involving local communities in order to influence individual risk behavior, improve verification, enhance product understanding, and foster trust. So, inclusive insurance could be a hot topic and one of the most important tools in coping against protection gap. The next slide. So now let's address the potential for inclusive insurance market development. Inclusive insurance is a promising market for emerging consumers, and creative risk takers have been developing business models to reach this market for years. Since the 1990s, the microinsurance movement has demonstrated the benefits of insurance for low-income people, as well as exploring new business models to serve these consumers. Next. Microinsurance pioneers targeted consumers in the informal economy who were underserved by traditional insurance. Microinsurance models match their premiums and benefits to the needs of these groups. But today, inclusive insurance expands this market and product development work to all those who have not been served by traditional insurance, including the lower middle class, while retaining a particular emphasis on vulnerable and low-income population. Inclusive insurance includes mass insurance and microinsurance, both offered to clients who are not in the radius of conventional broker or agent inherited from advanced market. Mass insurance is commonly described as products that are universal, standardized, and simple, generally not targeted as a specific segment, often subject to a differentiate regulatory requirements from microinsurance or traditional insurance. Can be distributed through a specific range of distribution channels commonly identified by terms such as mass channel. Mass insurance reaches out to clients from existing economic aggregators such as bank, microfinance institution, mutuals and cooperatives, retail distribution, religious communities, mobile phone operators. Those members may belong to various social classes, including even high-income earners to informal rural workers with irregular income. Next. There is a wide agreement that the market for inclusive insurance is growing. Allianz, for example, believes that the global inclusive insurance market has the potential to cover up to 3.5 billion people through market-based risk transfer solutions and public-private partnership. Much of this market is untapped, even though insurance is growing at the top end of emerging markets. Project growth in inclusive insurance is consistent with high growth in insurance in emerging markets overall, but this growth is starting from a low level. The most recent estimates on the microinsurance market show that 300 million lives currently insured. That is less than 20% of the total population in the relevant segment. While inclusive insurance still reaches a small fraction of the potential market, it is growing and gaining momentum. Next. The topic of inclusive insurance has gained importance because of number of reasons. Inclusive insurance can improve welfare over time, and it builds financial resilience to cushion individuals, householders, businesses, and communities from the finance impact of shocks. As a result, these actors are protected from falling back into poverty. Insurance provides a safety net for householders and small businesses. Moreover, it encourages ex-ante risk management, risk mitigation, and prevention, and it can thereby support public policy objectives such as food security, development of health and education system, or climate change adoption. By minimizing risk, insurance channels savings into productive investments in agriculture or micro, small, and medium-sized enterprise in another relevant factor. Next, contributing to financial stability, looking at the insurance sector with an inclusive perspective helps to identify informal insurance schemes. These informal schemes represent a risk for financial stability. The reputational risk of collapsing informal insurance scheme not only endangers insurance companies, but can also adversely impact trust in the other financial institution. So now so that's why we conclude that inclusive insurance has great importance for the overall economic being. Okay, next. Now, I would like to share the current status of inclusive insurance in the CET region based on the survey results. Next. So this survey was jointly conducted by support of Access to Insurance Initiative, Slovenian Insurance Supervision Agency, and with my personal involvement. The purpose of this survey was to assess the current status of inclusive insurance regulations and or initiatives promoting access to insurance in the CET region. The survey took place in March and April this year. The survey was sent to 32 authorities from 31 countries. Namely, in one country, like in Kazakhstan, we have another supervisory authority. Actually, there are two of them. 24 authorities participate in the survey, which represent 3/4 of the participants in the survey. The questionnaire was consist of 4 sets of questions covering the following aspect. The first set of questions cover the existence of inclusive insurance legislation and presenting any microinsurance or inclusive insurance products that exist in the CET member countries. The second set of questions were dedicated to assess of other supportive legislation on inclusive insurance. The third set of questions was related to the policy approach to increase access to insurance to low income and low middle income populations. And summary of the most relevant topics for supervisory capacity buildings was part of the last set of questions. Now let's see how were the results of the survey. So the next one. None of the authorities that answered the survey has microinsurance or inclusive insurance legislation in their jurisdictions. None of the authorities has a definition of microinsurance or inclusive insurance in legislation or a non-legally binding document such as a communique or an announcement or notification, guidelines, discussion papers, or a development plan. Next. Even though none of the authorities have regulation or a definition of inclusive insurance in force, there are some types of microinsurance products present at the national insurance markets. The most common type presents were agricultural climate insurance products. Property insurance targeted to the low-income market is also being sold in a few countries. It is important to state that 11 countries have one or more types of inclusive insurance products in their markets. Next. In countries that do not have these products in their market, majority of supervisors are not planning to create a strategy or an action plan in the mid-short term to develop inclusive insurance. One authority, Albania, attempted to develop such products through the project Inclusive Insurance Innovation Lab. Namely, Albania was the first country from the CEET region who participate in this project on Innovation Lab, which is part of the Access to Insurance initiative in increasing the the inclusive insurance presence. Okay, two countries, Lithuania and Kazakhstan, plan on developing a strategy for inclusive insurance. In Kazakhstan, the regulator is working to encourage insurance companies to develop standard typical agreement products that are easy for customers to understand and meet the needs and interests of the policyholder in order to ensuring effective and equal access of all segments of the population to financial services and increasing financial inclusion. Central Bank of Lithuania is open for discussion on any reasonable solutions, including inclusive insurance, which could help Lithuanian insurance market develop and grow. The majority of institutions, 11 of them, have a financial inclusion strategy developed. 3 authorities include the financial inclusion strategy in other strategical documents. One authority is in the process of preparing the financial inclusion strategy. Next. The second part of the questionnaire was dedicated to the supportive legislation, which deals with regulations that support insurance to be more accessible and inclusive by allowing and promoting innovation and helping to close the protection gap. While some authorities stated that there were no other supportive legislation, 12 authorities allowed the use of remote means, 5 countries digital models, 11 jurisdiction e-signatures in insurance operation, 6 countries mobile insurance, 5 regulatory sandbox, and 7 authorities had support the promotion of insurance against climate risk and disasters. One jurisdiction have created regulatory framework for recognition of index insurance, while another jurisdiction have supported the designing of insurance for small medium enterprises. 2 authorities declare supportive legislation on tech-full insurance, and 2 other supervisory authorities, they have legislation on fintech, insurtech, law regarding the mutual insurance companies. Next. The authorities were asked to identify the most pressing risks for the low-income and low-middle-income population. Answers provided include financial education, unemployment, mentality awareness, disease risk, natural catastrophic risks, property, inaccessibility of life insurance product, endowment insurance, healthcare, and etc. The most common answers were unemployment, property damage, including man-made or due to natural catastrophic, and healthcare. 2 authorities have conducted a market survey to analyze the need of the low and middle income classes in their jurisdiction. One authority intends to conduct a market survey in the near future, while 2 authorities are mentioning they will reconsider conducting the survey in the future. Only 2 authorities have in past performed a study on willingness to pay and ability to pay of the low and middle income classes in their jurisdiction. Next. And the last set of questions was to identify their needs in terms of supervisory capacity building. So as we can see from the slide, the most important topic for supervisory capacity building is establishing of risk-based supervision, consumer protection, supervision of new technologies, and of course everything that is related with the current trend of the impact of COVID-19. So basically, those were the most important findings of the survey of the inclusive insurance landscape. So we can conclude that inclusive insurance is not yet a topic that concern the insurance supervisory, but also the policymakers and of course the insurance industry. Now the question is, if there is a space for inclusive insurance in the CET region. Of course, the answer will be yes, there is a huge potential, and I will prove this with the next part of my presentation. So what are the inclusive insurance perspectives? The trends observed in the past have had significant impact on the field of inclusive insurance. The importance of insurance in building resilience of vulnerable groups against financial shocks has long been recognized. It provided the basis for the global work on inclusive insurance. Despite this, insurance has been largely underrepresented in the development. Now, in this table, I try to find the most important indicators actually that give some floor in order to identify the potential of the inclusive insurance. So all countries in the region, as we know from the beginning of the presentation made by Gorazd, that are very heterogeneous region and political and economic terms. Some of the countries belong to the EU. Some of the countries, they are in the process of accession to European Union, and some of the countries, they don't have in their plan to join the European Union. Then in terms of economic development, you can see by the data of GDP per capita that we have a huge difference in the level of economic development. However, the potential for microinsurance market belong and it's related with the level of poverty. For this reason, I identify two important ratio. This is poverty headcount ratio at 1.9 US dollar at the day, and poverty headcount ratio as $3.20 on a day. The microinsurance market potential is belong into two broad segments. Actually, those living above the poverty line of 1.90 US dollar day up to 3.20 US dollar day represent the target market segment for commercial viable microinsurance. People living below 1.9 US dollar referred to as an extremely poor population whose earnings are so little that they find it hard to afford even basic necessities for their families. And this segment is subject to large-scale social security measures. People who belong to above 3.20 US dollar a day are potential to traditional insurance market. Of course, not all the countries in the region belong to this range, but we can see that some of the undeveloped countries actually belong to this range. Also, we took into the numbers of the number of the employment people, the structure between urban and rural population, then the level of financial literacy and the level of financial inclusion, also gave us good ground that there is a huge potential for inclusive insurance. Also, one of the favorable things is the level of penetration on mobile phone, because the mobile phone could be a very powerful tool as a distribution channel for selling the microinsurance product. Next. Okay. So in this slide, what I like to point, maybe the last bullet, that the tomorrow's clients of inclusive insurance are after tomorrow's clients of classical insurance. So actually what we need, that we have huge underserved citizens who doesn't have any touch with the insurance, and through access to insurance, to microinsurance product, when they will first have experience and after their customer journey, then they will be ready even for the to enter into the classical insurance. Okay, next. Here is some comparison between the main feature of conventional or traditional or classical insurance and inclusive insurance. I believe that during the training session, you will go through these aspects and comparison between conventional insurance and inclusive insurance products. So I will not go more in depth. Next. The main feature of the inclusive insurance products are based on the following principles. The simple products, little or no underwriting. So the underwriting process should be very easy and fast. And in terms of condition of the products, must be few or no exclusions. Then the most important principle is to have short claim settlement period. Of course, the terms and condition or policy condition must be understandable and very simplified. And what is also important, that the pricing of the microinsurance or inclusive insurance products must be related with the community pricing. Next. Now we come to the last part of my presentation, and that is the role of regulation and supervision in terms of inclusive insurance. Supervisors are increasingly taking on a more active role in insurance market development, whether for the sake of the market growth or to contribute to national development objectives. The mandate itself is not new. Many supervisors from developed countries recognize development of the insurance market as a goal. A number of supervisors in recent years have formalized strategies, established departments, allocated dedicated staff resources, or undertaken concrete steps towards insurance market development, adopting market growth, inclusive insurance, and fostering technological innovation as a key objectives. Inclusive insurance is now a core policy objective among supervisors. Next. For many supervisors, the development of inclusive insurance markets started with a focus specifically or only on low-income population segments. However, supervisors are taking a more perspective to the underserved, recognizing that the low income and vulnerability coincide with other factors that may hinder uptake of insurance, such as gender, occupation, or state of formality. In the early years, regulatory strategies for inclusive insurance development had been shaped around products and providers. Over time, experience and emerging trends revealed that many of the challenges in relation to inclusive insurance that supervisors face are not exclusively to inclusive insurance products. These include data infrastructure and data analytic capability, transitioning to risk-based supervision, solvency regime, and actuarial capacity, financial literacy, digitalization, data protection, and regulating for innovation and product value, among others. Supervisor now had a wider range of regulatory tools and approaches in their toolbox for inclusive insurance. Rapid technological innovation gave rise to new regulatory thinking and approach such as wait and see, test and learn, regulatory sandbox, and innovation hubs. Some integrate financial inclusion as a specific objective or criteria, effectively being an additional means for supervisor to achieve inclusive insurance beyond the familiar approach of issuing inclusive insurance regulatory frameworks. Technology has also unlocked new possibilities for supervisor work itself. The emergence of RegTech, SupTech, and enhanced data analytics have introduced new ways to help supervisors optimize supervisory processes, while mobile applications and social media have opened up new ways of communication with educating and protecting consumer. Next. Also very important aspect from the regulatory point of view is proportionality. This is maybe the most important principle for inclusive insurance. In the respect of proportionality, taking into consideration the size, the nature, and complexity of the risk. Why is this important? This is important especially from consumer protection view. Also, proportionality can encourage innovation with partners outside the conventional insurance sphere. Next. I will end up my presentation on some thoughts how to implement regulatory frameworks for inclusive insurance. Developing an appropriate and proportional regulatory framework is key to support the development and growth of inclusive insurance. It requires a multifaceted approach tailored to the specific country context. Consultation with numerous stakeholders, targeted capacity building, and continuous monitoring are all essential elements of this complex process. Developing an appropriate regulatory environment for inclusive insurance requires the tailoring of intervention to the specific characteristics of each country. Nevertheless, certain general recommendations can be made. Successfully implementing proportional regulation requires a standard sequence of a country diagnostic, the development of regulatory roadmap, and the execution of implementation activities subject to constant monitoring and revision. Additionally, key elements such as consistent stakeholder dialogue and targeted capacity building should also be integrated in the process. The first step in the implementation process is to perform a country diagnostic. The diagnostic is an analysis of the country's broader financial sector context and the state of inclusive insurance market, and is meant to inform the recommendation for policy and regulatory reforms to promote inclusive insurance market development. The aim of the diagnostic is to assess the opportunities and barriers for financial inclusion in a given jurisdiction by examining the wider financial environment in terms of supply, demand, policy, and regulation. The diagnostic should provide the critical information needed for supervisors to design a regulatory roadmap and move forward with the implementation. Fundamental to this process is incorporating dialogue with relevant stakeholders such as the industry and insurance association, to obtain critical information and perspective. The second step is regulatory roadmap. The development of regulatory roadmap should take approximately 2 to 3 months and should also include capacity building activities for the respective supervisory authorities and industry. The development of regulatory roadmap can take the following activities: an assessment of the supervisory and regulatory authorities' internal capacity and mandates. This is key for ensuring that the supervisory authority has the ability to implement changes. Proportionality, understanding the market, inclusive insurance product, distribution channels, and partnership. Understanding the applicable regulatory frameworks such as Insurance Act, regulations, and guidelines. Ensuring that the industry is actively involved. Following the development of regulatory roadmap, the next step is implementation. The implementation component constitutes the majority of the process and typically lasts between 6 to 18 months or more. For effective implementation, consistent and ongoing dialogue with the industry is crucial. Industry input enables supervisors to understand key components or issues for the policy approach, current innovations, trends, and desires with the inclusive insurance sector, and areas of regulation that help or hinder insurance ability to provide inclusive insurance product. Those are critical elements that help set the foundation for smooth and effective implementation. Moreover, industry involvement helps build collaboration on other important initiatives such as financial education and assist supervisors in avoiding burdensome or over-costly regulation. Finally, ongoing dialogue with the industry enables supervisors to better understand consumer protection issues and needs and ensures that regulation strikes a balance between consumer protection and the ability of insurance to provide simple, efficient products without additional significant regulatory compliance cost. So those could be some recommendation that the supervisory authority can think and with the process of dialogue with like access to insurance. And I hope based on this training during this seminar will give you some inputs and some idea how we can start and to move the things from the ground. And I would like to point out in the end again that there is a need very wide multi-stakeholder approach, and in that respect, jointly with Access to Insurance, the Slovenian Insurance Supervisory Agency, IIS Microinsurance Network, and Munich Re Foundation, it will be organized a first inclusive insurance conference for the CET region in 1st and 2nd of September. And I would like to invite all of you to be part of this conference. So thanks a lot. We are running out of time, but I hope that it was useful. And if there is if there is interest for any additional questions, we are happy to answer. So thanks.
Thank you. And Goraz, that's a very, apologies, I've got a bit of an echo. Thank you for that very detailed presentation. It was really interesting, and thank you for also taking the time to join us today. And we do have time for questions if there are questions from the floor. And while I give a bit of time to participants to put their questions together, just to add on the conference that Klime mentioned at the end, we will be advertising that on the A2I newsletter and on the website as well. So all participants should get information concerning that as well. And we'll send it to you at the end of this conference as well. Also, I know a few of you have asked me whether we can share Klime and Gorez's slides. We will be sharing the slides with participants at the end of this training, and it'll be going on to the A2I Connect platform as well. That includes Andrea's session as well, on session 2. I have actually one question from my side. Klime, on slide 18, you touched on changing consumer behaviour, and in particular an aversion to loss, and especially smaller losses. I was just wondering, what do you think has been the instigator for that change in consumer behaviour? I think you're on mute, Klime.
Yeah, okay. I'm unmute. Okay. I mean, the customer experience regarding to the losses and the claims is very important to build the trust with the insurance industry. And general perception is that the insurance industry has a very low reputation and very low trust. So the supervisors should be aware that actually they supervise the industry who has very low level of reputation among even among the other financial service industry. So therefore, I mean, including the experience with the small losses when clients, you know, when there's a small claim, and if the insurance companies want to make, you know, they want to compensate the claims on a very fast and fair way, and then the clients actually will be because it's a small amount, he would not don't want to continue with with compliance against this claim, because it's a wasting of time. And in that respect, on from the client's journey, just he will leave the things, and then he will say, okay, I don't care about these claims, but for me it's a big minus against the insurance company. So therefore the small claims could be very important on building the trust to the potential clients.
And do you think that reputational image or damage has exacerbated due to, so I know in the UK, there's been a bit of a reputational damage done to insurance companies since the pandemic, in particular because of BI interruption cases, and also people feeling that when insurance matters, it suddenly isn't available to them. And I know there's been a slight reputational damage done because of that. Do you think there's a link to COVID-19, or is it just this is an ongoing issue?
No, this is a general issue, but regarding to COVID-19, I can share experience in Macedonia. Business interruption was not the case. So, I mean, business interruption as a coverage exists very little. But the death cases related with accident insurance and with the life insurance, in most of the general terms and conditions of the insurance contracts because of pandemia is excluded. But the Insurance Supervision Agency, I must say that takes some serious actions as a recommendation because of the low reputation in general of the insurance industry. In order to increase this reputation, they recommend to the insurance company to pay the death accidents that coming from the life and accident insurance, and the insurance company actually were willing and they accept this recommendation, and they pay the claims, because it was kind of joint action from, let's say, from all stakeholders, how to improve and how to build the trust among the policy, among the citizens. And of course, even some of the insurance companies they change their terms and condition, and like in travel insurance or in health insurance, even they now it's very clear stated that even they cover some of the they cover COVID risks.
That's great. That's nice to see that insurance companies are reacting and trying to preserve their customer base, essentially. We also have one question actually that's come through on the chat. The question is, what's the best strategy that any insurance supervisor can adopt quickly to mitigate the crisis due to COVID-19 by leveraging the inclusive insurance? Quite a challenging question there.
Okay, maybe Goras will take this.
I think you're on mute.
What is the best practice? From the supervisory side, I think that just to put a focus as much as possible on the continuous education of what benefits inclusive insurance can actually bring, because actually we cannot do much, because the companies themselves, they will decide about what to sell, and at the end of the day they want to see the profits. So we cannot influence the way they would construct their insurance products. They would come out with their insurance products, but it is just I think in given situation it is important, as it was said before, just building the trust in the insurance product. This is what the supervisor can do. This is the basic point. I think the basic premise is from where we can start, and I don't know what else can be done in these circumstances. But of course, with COVID-19 at this present stage, maybe population still do not feels in their wallet the financial consequences, but at a later stage they still can come, and that time there will be also importance of insurance as a long-term investor to step in. Hopefully I could respond partially to this question. Or Klime, do you have anything to add?
I think you've answered that question quite. It's a challenging question, and we actually have one more question that's come forward. Could you please refer a country case study success story of an efficient implementation of inclusive insurance? I'm not sure, Alex, is that, maybe you can come over, is that a question for Goraz and Klime, or is that for this training overall?
But I can also give some comments on that.
Let's go ahead.
Okay. Well, also in my presentation, what I mentioned, can you go like 2 slides back? No, one more. So here in before the last bullet, I said that there are some in place inclusive insurance regulation in some of the African, Asian, South American countries, and those could be a benchmark for the countries for the CET region, because no any single country in the CET region have experience in drafting inclusive insurance regulation. So therefore, the experience from the Africa, Asia, and South American countries could be some good benchmark, and on the website of the AI2I, you can find a nice report with the regulatory framework descriptions from different countries that were very successful in implementation the inclusive insurance, like Ghana, Kenya, Philippines, Chile. So I would say that, and that's why I put in our presentation as a recommendation that we have to follow the success of the countries from that region.
Thank you.
I think also the program leaders will be touching on a few case studies over the training on success stories of the implementation of inclusive insurance. And my colleague, for those of you that haven't seen it, my colleague's just added a link to the A2I on some experiences from South Africa and some success stories there as well. If there are no further questions, then thank you again, Goraz and Klime, for that really detailed presentation. And thank you also for taking the time to join us today. I know you both are very busy, and thank you for taking the time out of your busy schedules to join us. It is much appreciated.
Yeah, our pleasure.
Yes, thank you also for great content of the seminar, and I'm sure that all the participants will benefit greatly from the seminar. Thank you so much.
Thank you. Yes,
and
all the best.
See you, all of you, in 1st and 2nd of September for the Inclusive Insurance Conference.
Thanks, Klime.
Okay. And
Goodbye.
I wish you nice summertime for all of you.
Same to you. Bye-bye.
Bye-bye.
Ciao.